Okay. I've titled my talk today, 2018, A Year of Epic Market Disruptions, Part 2. Part 2 because I talked about that topic in January when I last spoke at this forum. Just a little advertisement, I run a radio show every week, a live web-based radio show with lots of very interesting guests that we talk about macroeconomics, the markets, and then usually have a corporate, usually a mining company guest on as well. The credit cycle, it's very well defined. It's not a business cycle, it's a credit cycle. Everything is really driven by the money spigots out of the Federal Reserve and other central banks around the world. And this is sort of, Alistair MacLeod, who's a frequent guest of my show, has talked about this, and has defined this, and I think he has it nailed pretty well. First, let's start out with a new cycle which begins after the implosion of the past one. I like to call this the despair and reaction portion, phase one of the cycle. That's after the devastation of the last bubble. When it implodes, everything basically comes to a halt. The market seize up. Prices collapse across the board for almost everything. Stock market, of course. The only thing that does better then are the bond markets. The interest rates collapse, so if you're holding bonds, the value of your bond goes up dramatically. Of course, the Fed steps in with massive amounts of money printing, Keynesian economics in action. I like to call the second phase stabilization and green shoots. That's when the decline is discontinued and there's sort of a stabilization period. Interest rates stop falling. There's money being poured into the system. The banks start to make huge amounts of money in both phase one and phase two because they're owning treasuries and their treasuries are making big gains. It's a period of time when a lot of hanky-panky, a lot of new creation, new credit and new financial instruments are created, and the banks have endless amounts of money to play with, and they put it to work in ways not to the economy, but for their own purposes primarily. And remember that the Federal Reserve was created not to really make the economy better, but to make sure the banks were solvent and would stay in business and not go belly up. So we get the stabilization, phase two, then phase three. We start to get a little bit of real economic growth. Inflation a little bit, at least prices stop falling. And we start to see a demand for money from the private sector starts to come into play. Central banks become less accommodative during this time period. And the banks start to have rising interest rates a little bit, or at least they stop falling. So there's no gravy for the banks in holding bonds anymore, and they start to think about making loans. The real economy is getting a little better, so they start making loans. I call this, well, that's just really the real economic growth and inflation start to emerge in the phase three. Phase four then, which I call the threshold of lethality, is when the banks really start to, the banks have forgotten about the losses 10 years ago, in 2008 on their loans, and they can't make money on treasuries. In fact, if they hold treasuries, they're losing a lot of money because interest rates are starting to rise. And so the banks really just go hog wild in lending money, fast and furious, craziest kind of loans you can imagine without worrying about whether they'll ever get paid back. And we go through this cycle time and time again. So of course we just finished that with the housing collapse, and now we're on to the next cycle. But I'd like to go through, look at some yield curves at the peaks and at the bottoms, and at the bottom of the last couple of cycles. This right here is March 24th. This is the dot-com bubble, March 24th, 2000. This was at a peak of the S&P at 1527, and you can see the gold price was 284 at that time. But look at the curve. We have an inverted curve, which is usually a flat or inverted curve usually portends trouble ahead because there's a lack of liquidity at the short end of the curve. The short end, the interest rates go up because of a lack of liquidity. Demand is high. and the banks aren't pushing money into the system anymore. This is the point, the breaking point, the threshold of lethality, as I like to call it. Then the system implodes and you get a curve that looks like this, and you get a S&P that has lost a lot of its value. Still look at the gold price. It's up higher than it was at the peak, at the last peak. But you see the yield curve is steeply dipping. This is a good time to buy stocks, a bad time, it's just a real good time for stocks and financial assets, because it's the time when we don't want to buy them, because in our gut we feel like, oh wow, this is really a dangerous place to be, everybody got whacked. But if the system survives and the money goes pumped into the system, then the people who go out and buy the mainstream stocks and stuff do extremely well. The banks start to, again, this is the phase one now, the banks start to load up on bonds, they do extremely well. But the money doesn't get into the Federal Reserve starts to print, the banks, central banks start to print money, which also pushes the curve down and makes it steeper. So that's what happens here at this stage, phase one. That's the beginning of the cycle. Okay, so here's the housing bubble in 2010. You see 1527 on the S&P. It's gained a lot, but look at gold, $745. So gold keeps going up on all these extremes. It's on an upward trek. But again, this isn't an inverted curve, but it's a flat curve, and it's portending danger ahead. This was the peak of the S&P, and that's your yield curve at that point in time. So of course, that was right before the most cataclysmic decline we've had since the Great Depression, arguably worse than the Great Depression. Okay, so here's the bottom of the housing bubble, the implosion of the bubble. And again, you see the steep curve, but look where gold is again. It's up again a lot from where it was before in the last cycle, at the peak, and at the last, it just keeps going up. Measured in dollars, it keeps rising. And this is a period of time then, of course, when the banks really do extremely well, as they have been doing, and the 1%ers keep getting richer and richer, and Main Street keeps getting poorer, and the middle class keeps shrinking. This is what's been in play for a long time, primarily since 1971 when we went off the gold standard, but it's becoming more and more pronounced with each cycle. So now, where are we now? You can see the yield curve at this point in time. Again, it's not inverted, but it's getting pretty flat. It's suggesting that we're getting close to the end of this big 10 years of the recovery in the equity markets and the bond markets. Of course, the bond markets, interest rates are starting to rise. And I think they have to rise because of a shortage of savings and the amount of money that has to be raised to fund the U.S. Treasury deficit. And Trump is going to be running a $1.2 trillion deficit, and the Federal Reserve is pulling $600 billion out of circulation, essentially. And so interest rates have to rise, but how far can they rise? I think that we are now somewhere transitioning between stage 3 and stage 4. We're seeing some growth. I think we're starting to see some increased growth. I'll go through a few slides here that sort of make the case for the kind of economic picture you see at the top, or at the top of one of these bull markets and equities. So this is the 10-year Treasury, and of course, most of the increase in rates have come at the short end of the yield curve, but you can see the 10-year has also gone up a little bit. But look at that, 4% on the 10-year was sort of a line in the sand until this last disastrous money printing episode by the Federal Reserve after 2008. The problem is now a 1% interest rate rise for the United States Treasury is going to cost about $220 billion more a year in interest expense. So it's just really an enormous concern is that as rates start to rise, and they must to finance the deficit, then the U.S. budget is going to be in big trouble. And if we get anything like normal rates, how far can it go? What is the threshold of lethality for the system? Nobody knows for sure, but it's getting, we're getting closer to it. Here you see one of the things that you expect when in the recovery is commercial loans and industrial loans start to increase. So you're seeing where the last peak was. Well, recently you have a fall off after the 2008-2009 financial crisis, and you can see the numbers there. Now we're going up. This is consistent with the phase 3, phase 4 of the cycle. Commodity prices are starting to rise. This is the Goldman Sachs Commodity Index, up 69% since January 2016. One thing that is really consistent is wages go up. They're strongly correlated with rising interest rates. So as interest rates go up, real wages go up for people. When interest rates come down, Wall Street has a field day, and the masses, the middle class, gets hosed pretty badly. That's over many, many cycles, that's true. The wages are definitely on the rise, again, consistent with phase 3 or 4, especially phase 4. I think we're just starting to get into phase 4. Input costs are rising. This is the ISM prices paid composite of that index. And so this is, it's going to start costing more to produce things. And this is also consistent with phase 3 or phase 4 of the cycle. So here we are with this flat curve suggesting, again, I would point out where we are now with gold at $1,300. Remember back there it was 200 and something, and now we're at 13. Through all of these struggles, ups and downs, gold is continuing to rise. Yes, we've had a 5-year bear market starting in 2011, but in the larger scheme of things, I think we're still on to something much bigger. Commodity prices relative to stocks. Here, this shows it. This slide is probably about 5 or 6 months out of date, but nonetheless, it's still pretty relevant. Stocks, commodities have not risen hardly at all against the S&P 500 relative to. This is the price of gold at the end of each year since 1880. And again, it isn't that gold is going up in value, it's that the dollar and other fiat currencies are losing their value because they're being printed in infinite quantities. So you have, the thing I would like to point out is that gold does perform best after the implosion of, when you have at the end of the credit cycle, gold shares also tend to do very well because, at least the producing gold companies, because their costs are going down. The cost of commodities and other things collapse, and gold is usually a leader among the commodity sector, and we certainly saw that coming out of the 2008-2009 episode when gold really took off. Because massive amounts of money were being printed, so gold had to go up relative to the units of currency in circulation. This is the TSX Global Gold Index, Gold Share Index, and it shows, we got up to 2011, we got up there pretty nicely, come down pretty hard, and after 2011, and now we're still sort of meandering around, really very lackluster, this sector. Now, the one thing that I'm trying to really focus on, because I don't want to be holding shares, junior or producer or otherwise, when this thing collapses, because the shares go down, get taken down very, very hard. You'll have, a 4 or 5-fold increase in a bull market for the gold shares for the TSX, S&P TSX Gold Share Index, but you lose 80% in a very short period of time. So having some sense of when to get out and when to get back in is very, very important. I'm relying very, very much on Michael Oliver, who is on my radio show almost every week, because he's just been so darn good when it comes to assuring me I'm in the right place. He has had several occasions where people started getting really nervous about the gold price, and his approach is really he uses a momentum structural approach, which is proprietary. He was employed by large institutions in the past. Now he's on his own. But I've just gained confidence not only on gold, but almost everything he does. His proprietary analysis has really held true very, very well. Just overall, he's very bullish on commodities. He's very consistent with Alistair MacLeod's credit cycle and the one that I just discussed. He's short on sovereign debt, including the T-bond, the U.S. JGB bonds, the dollar. In spite of the fact that the dollar has risen recently, he sees it in a long-term bear market, and he's for sure short on stocks. And of course, I think that's the one that is stubbornly refusing to go down, but he's very confident that that day is coming. So I've just talked about the credit cycle. I think it's very well defined. I think we can look at, if you watch the credit cycle, forget the business cycle, it's all about credit. The really big dollar picture, this is the slide I think that's most important because debt is growing much more rapidly than GDP. Even if you believe the government's numbers for GDP, which I don't, I think they're overstating the amount of income. But if you do, you can see the disparity. Now, you don't have to be a rocket scientist, I think, to see that sooner or later something's going to break down when debt and the cost of carrying a debt is going up exponentially and income is flatlining. So a lot of people have called this the everything bubble. Will this break the dollar system? I don't know what the answer to that is, but it's certainly it's the exponential rise of debt to GDP. It's just, as that last slide showed you. And each financial crisis, bubble after bubble, is worse than the previous one because they never allow the system to be cleared of the debt. The Fed comes to the rescue, piles more debt on top of debt, and the whole system is run on debt money, on fiat money. And then there's growing political threats to the United States empire, I would argue. The economic powers of China and their alliance, India, resource-rich countries like Russia, Brazil, South Africa, in the BRICS, and then the institutions that have been set up, like for the petro yuan, where China and other countries are refusing to pay in dollars for their oil imports, I think is something you really need to keep an eye on, and also the fact that in the Shanghai Futures Exchange, people can easily take, the sellers of oil can easily take their yuan and exchange them for gold. So this is, I think, potentially a game changer. It's really big, but I would suggest that if you're not familiar with this debt clock, go to your computer and put it in and watch this thing go. I mean, it's just amazing. It's real time, not here, but if you go to your computer, it's real time, and it's just amazing. I think I looked at this on Monday, and I think the debt is 11 billion higher, or something like approximately 11 billion higher than when I took a picture of this on Monday before coming here. So the economics and the mathematics don't work. With a couple of minutes I have left, I'd just like to go over a couple of the slides, the companies that are here that I've invited to this show. This is the good news, I think. I mean, the gloom and doom Taylor, I know, but I think that the gold story is a good story, and it's where you need to be. And I think right now, with the gold shares not really doing that well, listen to the fundamentals that are going to be talked about with these companies and others. I think it's a real opportune time to buy some shares. But here's a Klondike Gold. It's the first systematic exploration of the mother lode of the Klondike, the Great Klondike that produced some 20 million ounces of gold. There's a major fault system that runs through this for 55 kilometers. Peter will talk to you in a minute about it and explain more about it. But they've some bulk mining targets. Actually, Peter was telling me this morning that he thinks it's very akin to the Kaminak discovery, and he can explain why that is true. Skeena Resources, one I really like a lot. They're developing the snip mine. All of the advantages, disadvantages that when Barrick operated this project are gone now. The infrastructure is there. The price of gold is 5-6 times higher. It is really a great story, I think, and apparently lots of really high-grade gold. I think one of the, if not the most highest-grade gold project in the history of Canada. Very, very interesting story. And Kelly will talk to you about that in a few minutes. Balmoral Resources, well, yes, I think they've got this Grisette project, predominantly a nickel project, that I'm quite sure is going to be, people are going to start hearing about this project because nickel is coming into vogue, of course, but it is a big deposit and it's one of the most developed projects out there with a major nickel project. Also, the Martiniere Gold Project is also very attractive. Anyway, we'll be hearing from Darren on that in a few minutes. And then the only stock represented here on this in this section is Tellson. The only stock that has risen from lower left to upper right is Tellson Mining. It's not the fault of these other teams, but Tellson is really doing a good job of putting their 2 mines into production in Mexico, polymetallic mines. The economics look very, very good, and so we'll be hearing about that in a few minutes. So that's really it for me. Jay Taylor Media is where you can go to find out more about me, where you can also tune into my radio show as well from that site. So thank you very much for your attention.